Hi, this is Amit Nigam from Peerless Mutual Fund, and in this presentation, I would like to discuss the philosophy and process that we follow with regards to our equity investments. Our aim is to create value for our investors. And how do we intend doing that? We invest in a disciplined and transparent manner, communicating well to our clients and then matching our words with action. This process, if followed, we believe it will inspire trust in our mutual fund. And trust is a key building block to inculcate a long-term relationship with our clients. By doing this, we are offering to our clients a portfolio strategy which gives them an opportunity to create true wealth and not just trying to outperform a benchmark index by a few basis points. Our aim is to offer an investment strategy that is differentiated from the rest of our industry. And how do we intend doing that? We provide a change from the normal momentum-focused portfolio strategy followed by most of our industry peers. We are offering to our clients a compelling diversification opportunity, as this process will ensure that the product run by us is not just trying to mirror an index. Now, if I were to put these words into action, how do I implement it as a process? First of all, let me touch upon some investing basics. We at Peerless Mutual Fund strongly believe that avoiding a permanent loss of capital is far more important than earning spectacular returns. If I were to just illustrate this with an example, if a stock were to go down by 80%, then for it to come back to its original value, it would have to gain about 400% from those levels. Hence, it is important that we protect the downside of our portfolio. Now, there can be multiple factors which contribute to the permanent loss of capital. And the best the investor can do is avoid the big mistakes. And these big mistakes we have classified under two broad categories. First is buying a low quality business or management. And the second is buying a business at a wrong price. Here again, if I were to illustrate with an example, if one were to buy Satyam in the year 2000, then by the end of this decade, his entire capital would have been wiped out. Whereas, had the same person bought Infosys at the peak of its price in the year 2000, he would have had to wait several years just to come back to its original wealth. And therefore, he has lost a valuable time, which in our parlance we call cost of opportunity. Our focus, therefore, is to avoid these mistakes than try to capture every available gain. So, at Peerless Mutual Fund, how do we avoid these mistakes? We spend a bulk of our time, in fact 80 to 85%, gaining knowledge of the business and management where we are investing. So how do we analyze these businesses? We look at three simple things when we are evaluating them. First, does the company use its capital efficiently? Does it have good return ratios? Does it have a reasonably consistent track record of free cash flows? And then it would be able to service its capital well. And lastly, does it have a sustainable competitive advantage? Because that is what earns it the healthy return ratio and also sustains them in the long term. When analyzing management, we look at four things. We focus on those management which have navigated multiple business cycles. We back those managements who have displayed integrity in communication and action to all its stakeholders. They have a track record of treating their minority shareholders fairly. And last but not the least, if they have a robust succession planning in place, so that in case the business leader were to be incapacitated for any reason, the business does not suffer. Now that we have set boundary lines for ourselves, we will necessarily avoid those businesses which are very new, they are untested, and therefore our portfolio will typically have stocks or companies which have existed for at least a decade. We would avoid those businesses which require periodic capital infusion, so whether it's equity or debt, to survive or to maintain growth. For example, we will tend to avoid businesses like real estate, airlines, etc. Again, Though businesses which are not leaders in their industries or are strong contenders for that position are something we will avoid in our portfolios. Similarly, on this management, we would avoid untested new managements and those managements definitely who have a history of mistreating shareholders. If I were to look on the valuation side, by virtue of being invested into the companies who are leaders and have high returns of capital, these companies tend to be valued at a higher multiple than the rest of the industry. And therefore, our companies would tend to be expensive than the stocks held by our peers. Since we are not comparing our industry, our multiples with some other benchmark, we would tend to look at the historical valuation of the same company and we would tend to buy them if they are available at a discount to their own history. And we are not just looking at price earning multiples because we know that PE ratios can sometimes be misleading, especially at the bottom of a business cycle. And anyways, we rely more on cash flows and balance sheet driven ratios than just P&L driven ratios. The goal is to buy stocks at a valuation which is below the historical averages and thus have an added safety margin. Let me highlight the strengths that accompany our strategy. We are clearly looking beyond the index. Most of the indices in our country are based on market capitalization or some variant of the same. And these include stocks which have either performed earlier in the past and not necessarily the stocks which will perform in the future. Since our portfolio strategy has its eyes firmly on the future performance potential, we would tend to buy those companies. We could also be looking at companies which are having a good long-term potential, and we need not be looking at those companies which have some near-term performance triggers. And therefore, we might be buying stocks which are not so much in flavor today. And this will give us an opportunity to accumulate our stocks at our own pace. And lastly, we are able to look beyond market cycles. Because if we are buying a high quality stock at the right price, we believe that it offers more safety than taking a call on economic or market performance. We believe that if you're buying a good business at the start of a cycle, it will help us capture the upside, and the quality of the business would safeguard the portfolio in a negative cycle. Let me also touch upon the risks that accompany our strategy. Now, since our portfolio strategy is not restricted to the benchmark, we would be having a scenario wherein in short periods of time we underperform the benchmark index, because our portfolio would be having stocks which need not be present in the benchmark and we might be running a low matched weight. Since we do not look at stocks which have immediate performance triggers, there might be times when the undervalued stocks which we have invested in might continue to remain undervalued till the market actually sees value in them. And therefore, this can also impact our short-term performance. And lastly, since the portfolio strategy is not so much focused on the economic or market dynamics, the short-term performance can again be hampered by the same. Having said this, in terms of process that we have at Peerless Mutual Fund, we would be starting with something we call investment universe, which will be the BSE 500 stocks. On this, we will have quantitative filters like return on capital employed and free cash flows for manufacturing companies, and return on assets and return on equity for financial institutions, to narrow down to a smaller set of companies called investment ideas. On these investment ideas, we would then have qualitative filters, wherein we would evaluate the sustainability of the same return ratios and free cash flows in the future, and analyze the management in detail. Having done that, we will be working on a smaller set of companies. My sense is in the number of 70 to 80 stocks, which we will be calling investable universe. And lastly, the portfolio that we'll be constructing would contain stocks which will be a subset of the investable universe, and this will be the stocks where our allocation would depend on the valuation history of these stocks. Lastly, we would keep a flexibility of about 15% in our portfolio to be able to capitalize on any short-term opportunities that come up to benefit our investors. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.